All right, so what we're going to go over here is chapter 22. This is the appraisal chapter. In your textbook, this would be page 443. So without further ado, we'll get right into it. If you guys look in the first paragraph on page 443, it defines what the word appraisal means. Now, for our test, the one thing we have to know for the term appraisal is that an appraisal can only be done by a licensed real estate appraiser. We as realtors, we do what's called a CMA. A CMA is a comparative market analysis. That's essentially our version of doing an appraisal, but the term appraisal can only be done by a licensed real estate appraiser. So the first thing I would note if they ask you on the test is who can do an appraisal. An appraisal may only be done by a licensed real estate appraiser. And I'll write that on the board right here. So the term appraisal So again, an appraisal can only be done by a licensed real estate appraiser. So even when I make these videos, I still write on an upward slant. So hopefully you guys will be able to read this. I'll get out of your way while I go on to the next topic. So next topic we talk about is market price and market value. So market price and market value in an ideal world will be just about the same thing. But for market price and market value, they differ, a little bit. So market price we say is what a home sells for. Market value we say is what it's worth. Now, the only time they'll really differ is if you have an extenuating circumstance where, sellers under the gun to sell because they don't sell by a certain date, the bank's going to foreclose. Or I saw a sign hanging from a telephone pole that said, I buy houses for cash and I close in 6 days, and I just inherited this property, and all I want is to stick some money in my pocket, so maybe I just dish it off real quick. That might be when it sells for market price. So market price, we say, that is simply the sales price. And market value is based off this ready, willing, and able concept. So market value, if a home sells for market value, we say we have a ready, willing, and able buyer, ready, willing, and able seller. The seller is not forced to sell, the buyer is not forced to buy, and the home is marketed for a reasonable length of time. I'm going to write this on the board up here behind me now. So for market price, we say this is simply the sales price. And then market value, this is based off that ready, willing, and able concept. So you would have a ready, willing, and able buyer and seller. The buyer's not forced to buy. The seller not forced to sell, and home is marketed for a reasonable length of time. So again, market price we say is what it sells for. So we say market price what it sells for. Market value we would say is that's what it's worth, and it's based off that ready, willing, and able concept. So if you guys want to pause for a second and write this note down, I'll get out of your way for a second here. And next here on the bottom left of page 443, we can start getting into the different types of value here. So, it gets into talking about things like market value that we just talked about, assessed value, which is for tax purposes. We'll go over that in the tax chapter. We talk about things like book value. We would use the book value for income-producing properties, because for income-producing properties, we can depreciate them for tax purposes. And number 4 here talks about loan value. So for this chapter, number 1, what I want to kind of go over right now is how does a bank go about determining value for loan purposes? We also go over this in chapter 14 with mortgages, but for now to put it on the board, if they were to ask you how does a bank determine value for loan purposes, the way a bank goes about determining value, they take the lower of the appraised value and sales price. So for example, if I'm under contract to buy at, let's say, $650, and the bank comes out, who I'm taking out the loan from, the bank comes out and they have an appraisal come back at $625, the bank's saying, we don't care that you bid $650. Our appraiser's saying it's only worth $625. So if you want to go through with it at $650, you can. You just have to increase your down payment by $25,000. But if you want to get a loan from us, based off a $625 purchase price, you're going to have to ask the seller to lower the price by $25,000. So again, the way the bank goes about determining value, it's based off the lower of those two. Now, if the reverse was true, let's say that home appraised for $650 and I got it for $625. We're doing backflips as the buyer, the bank, because we're saying we just walked into $25,000 in equity. They're still going to use the 625 number though, because they use the lower of the two. So if on the test they ask you, how does the bank go about determining value for loan purposes? It's based off the lower of the appraised value and sales price. And I'll write this on the board up here behind me. So again, the way a bank goes about determining value based on the lower of the appraised value and sales price. So again, the bank goes about determining value based off the lower of the appraised value and sales price. So again, I'll get out of your way for a second if you want to pause the screen and take a note of that. Then on the right side here of page 443, it talks about some of the economic characteristics of value. So, we use this acronym DUS, which stands for demand, utility, scarcity, transferability. So in regards to demand, utility, scarcity, transferability, all parts of those four will ultimately go into determining what the value is. So obviously if there's high demand, the price is going to be higher. High demand and low supply even better, because then you're really going to get higher prices just due to simple supply and demand. Utility means usefulness. If the property's not useful, it's not worth anything, because if we can't use it, we can't sell it. And then T, transferability. Can I transfer the property? If I can't transfer the property because maybe there's a writ of attachment, maybe there's something like maybe a list pendants against the property, perhaps maybe there's a current lawsuit pending that's preventing me from selling it. If I can't transfer the property, I can't sell it, I can't get money for it, so we would have no value. But by far, the number one determination of value is location, location, location. The reason I also bring this up is on the state exam, they will sometimes refer to it as situs, S-I-T-U-S. I'm going to write that on the board up here. So if they ask you, what is the number one determining factor for value, that is location, which is commonly sometimes called situs, S-I-T-U-S. So location, they can also call situs, and this is the number one determining factor for value. So again, if on the test they ask you, what is the number one determining factor for value, that's going to be location. So again, I'll get out of your way so you can pause the screen and make a note of this if you need to. So we can turn the page, go to page 444, the second page of the appraisal chapter. We'll start off with number 3 there, the principle of substitution. So the principle of substitution, this is the principle of value that we would use for the sales comparison approach. Now we're going to talk about the sales comparison approach in a little bit, but if they ask you what is the principle of value that you use with the sales comparison approach, that's going to be the principle of substitution. So what the principle of substitution states is that the cost to acquire one property is generally not going to exceed the cost to acquire a similar property of equal desirability. So in other words, when I go out to a client's house, they want to know what their home is worth. What I'm going to ultimately do, I'm going to look at the neighbors' houses that I've recently sold, if there's any homes in that neighborhood that are similar as far as style, bedrooms, bathrooms, square footage, things like that. And I'm going to say, okay, my neighbor's house, identical to mine. We were both built 5 years ago by the same builder. We both did no updates. They're 4 bedrooms, 2.5 baths. I am 2. We're identical. They just sold for $700,000. My home's probably worth, $700,000. How did we determine that? We substituted that sale with my house, and we came up with $700,000 in that case. So just in general, that principle of substitution, we're trying to substitute one property for another to determine what the value is. So I'll write the definition up here on the board for this. So we're really going to write down 2 things for this. Number 1, the definition, and number 2, where it might be used. So again, the principle of substitution, first and foremost, number 1, it is the principle of value that we use for the sales comparison approach. And number 2, if they ask a second question about it, they might say, what does it state? It states the cost to acquire one property will generally not exceed the cost to acquire a similar property of equal desirability. And this here is called the principle of substitution. I'll write this on the board here. So again, this is called the principle of substitution. So number 1, this is the principle of value used for the sales comparison approach. And number two, they might ask you definition-wise, and again, I'll write the definition up here. So if this states the cost to acquire one property generally won't exceed the cost to acquire a similar property of equal desirability. So again, cost to acquire one property will generally not exceed the cost to acquire a similar property of equal desirability. So I'll get out of your way for a second so you could pause the screen and take a note of that. Next thing that we'll go over here is number 4. And again, this is number 4, the highest and best use. Now, if I were you guys, what I would do is I would just highlight the first sentence in your book for that. The principle of highest and best use states that basically, what is the greatest use of your property? What's the greatest use of your property that's going to generate you the greatest net return over a given period of time? So if I'm giving a blank canvas of land that's 5 acres and the town's going to say, go ahead and subdivide it, build 20 homes, I should probably try to subdivide that and build 20 homes, rather than just build a small little 3-bedroom ranch there. That's the highest and best use of the property. So for number 4 here, highest and best use, just highlight the first sentence there. Number 6 would be the next one I think is important. That's the principle of contribution. So what the principle of contribution states is that any improvements or additions that you're making to your property, they're only worth what they add to the market value. So for example, if you go out to a client's house and they say to you, hey, I just spent 50 grand on updating my kitchen. I know my neighbor's house just sold for 650. I got to get 700 then. It doesn't work that way. For instance, if they spent 50 grand, it might have only added 20 in value. Whereas in other places, maybe they spent 50 grand and it added 150 in value. So it really depends on what they did there. But the principle of contribution with that states that any improvements or additions that I'm making to my home, they're only worth what they add to the market value. So I'll put that on the board up here. And again, that's called the principle of contribution. That's number 6 in your book in the second page of the appraisal chapter. So again, that's number 6 there, principle of contribution. So again, what it states, you guys can just take a note up here. Yeah, that's what I just talked about. Number 8 here is the next one that I think is important, and that's the principle of conformity. But the principle of conformity states that when homes are similar in an area, that'll stabilize value. So if you had a neighborhood that was just built, a subdivision, it's all 4-bedroom cookie-cutter homes. They're all probably going to sell for like pretty much the exact same amount, unless you have a superior location with like a New York City view and things like that. But just in general, number 8 here, principle of conformity. What conformity does, that will stabilize values. So they ask you what conformity does, that stabilizes values. I'll write it on the board because, in the book it doesn't exactly say that, to a T, but that's what I'll write on the board up here. So again, conformity, that's when homes are similar. This stabilizes values. Again, conformity, when homes are similar, that's going to stabilize values. Next here, also on the top right of 444, still under number 8, talks about the principle of regression and progression here. So the principle of regression, if you guys have ever heard the term like never buy the nicest home in like a crappy neighborhood. The reason for that is because if I buy a really nice house that's, let's say, a 5-bedroom custom home surrounded by rundown 3-bedroom ranches, in a situation like that, I'm going to get far less money than I would if I bought by homes similar to mine. So principle of regression states that homes of greater value and greater quality will depreciate in value and lose value more rapidly due to what they're surrounded by. Whereas the principle of progression states kind of the opposite. The principle of progression says buy the crappy house in a really nice neighborhood because then every dollar you spend you might get $2 back, for example. So principle of progression states that lesser value or lesser quality homes, when surrounded by greater value or higher quality homes, is going to tend to appreciate in value more rapidly. So you guys could actually highlight the definitions here. They're on the top right of page 444, so I would highlight those there. Then number 10 there talks about the principle of plottage. Now, plottage would be the increase in value due to what we call assemblage. So what assemblage is, that is the bringing together of two or more properties to form one. Use common sense. If you assemble something, you put something together. So assemblage, again, that is the bringing together of two or more properties to form one. The increase in value from assemblage we would refer to as plottage. So again, assemblage is the bringing together of two or more properties to form one. If there's any increase in value due to assemblage, we would refer to that as plottage. I'll write all this up on the board here. So again, assemblage, the bringing together of two or more properties to form one. So again, assemblage, bring together two or more properties to form one. If they ask you, how do you explain the increase in value due to assemblage, we call that plottage. So again, plottage is the increase in value due to assemblage. So again, plottage again, plottage is the increase in value due to assemblage. So I'll get out of your way so you guys can make a note of that here. And next here on page 445, this is where we start getting into the different types of appraisal approaches. So the number one appraisal approach that is tested on is what's called the sales comparison approach to value. So I'm going to write some rules up here for the sales comparison approach. And as I always like to say, they're going to make no sense when I put them up here now. After I go over the examples, they will make more sense. So bear with me while I put these up here. Hopefully they'll make more sense after I go through the examples. So again, this is the sales comparison approach. And the first thing, if I were you, that I would write down for this, it's the most common approach to appraising property. So if on the test they say, what's the most common approach to appraising property? The sales comparison approach. This sales comparison approach, this is where we use that principle of substitution that we talked about a few minutes prior. So we're going to go over this now. So again, this is called the sales comparison approach. So let me just get this up here. So again, first and foremost, write down this is the most common approach to appraising real estate. And again, this is called the sales comparison approach. So I'm going to write 3 rules up here, then we're going to go over an example. So with the sales comparison approach, you're going to have your comparable home sales, the ones that recently sold, and what we call your subject property. Your subject property, to give you a real-life scenario, somebody calls me up and says, hey, I want to sell my home. I first want to know what it's worth. Can you meet with me? I go to their home and I meet with them. When I meet with them at their home, it hasn't sold, so I don't know what it's worth. I got to figure out what it's worth. They're my subject property. So therefore, we would never, ever, ever make an adjustment to the subject value because that's what we're trying to find the value of. On the test, what they're going to ask you is what you make the adjustments to. The adjustments to value that you make adjustments to the comps. Because the comps have already sold. You know what they've sold for as well. So for the sales comparison approach, and I'm going to write this up here, you would never make an adjustment to the subject. And again, right now you guys might be confused as hell saying, what is he talking about? This will make more sense when I write the example up here. But first and foremost, just write down when you're making adjustments, you never make an adjustment to the subject because the subject doesn't have a value yet. So number 1, you never make adjustment to subject value. What we make adjustments to is the comps. And the easiest way to remember this, I always say, is use these stupid little acronyms, CIA and CBS. CIA stands for if the comp is inferior, we would add. So in other words, if the comp is inferior, in other words, worse than our subject property, we would add to that comp's value to find the value of the subject. Again, I understand this probably makes no sense right now. It'll make sense when I put up the example. And then CBS, if the comp is better than our subject property, if the comp is better, we subtract. CBS, comp better, subtract. So I'm going to put this on the board and then go over an example with you guys. So again, CIA, if the comp, in other words, comparable home sale, is inferior, we would add to its value to find the value of the subject. And CBS, if the comp is better, you would subtract from its value to find the value of the subject. So, write these down. If you need to pause for a second so you can write these down. I'm going to get right into the example here. So, over here, we're going to have 3 separate home sales I'm going to put up here. Actually, we'll do one example at a time. So what I'll first do is, what if you're looking at your subject property and they tell you the comp is better? How would that work? So, give you guys an example. Let's say that this is our house here, and this is the comp here. So this is our subject property, and let's say that we're 4 bedrooms and 2 baths. This is comparable home sale number 1. It's actually a better comp, and the reason why it's a better comp is it's 4 bedrooms and 3 baths, and this here sold for $525. So it's 4 bedrooms and 3 baths and sold for $525. Now they're going to tell you, like for instance, let's assume all else is equal, except they have 1 additional bathroom. Now if all else is equal and they have 1 additional bathroom, which house is going to be worth more? The comp is, because there's 1 additional bathroom, right? So therefore I know that whatever we place a valuation on the subject is going to be less than $525. Now just to keep it really simple and easy in your head, if you remember these acronyms over here, it's going to make your job a lot easier, because we would then just say, all right, well if the comp is better because there's 1 additional bathroom, comp is better, we do what? We subtract. So in a situation like this, we got the 525, and when we have the 525, they're going to give you an example in the test. They're going to say, your comparable home sale is 4 bedrooms and 3 baths and sold for $525. Your subject property is 4 bedrooms and 2 baths, and this sold, and we're trying to figure out what this is going to sell for. What adjustment would you make here? Now, if on the test they ever say make an adjustment of the subject, cross that out. Before you even read the question, if one of the answer options says, make an adjustment of the subject, that's not the answer, because you never, ever, 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 ever make an adjustment of the subject. You only make adjustments just specifically to the comp. So in this case, we know what this sold for. And if the comp is better, we do what? CBS. If the comp is better, we subtract. So they're going to tell you the extra full bath is worth, let's say, $25,000. Okay, so it sold for $525. I subtract $25,000 from that. This comes out to $500. I would then say, all right, I figured out that my subject happens to be worth $500,000 in this case. So again, being that the subject's worth, the subject's worth $500,000, how did I figure that out? I saw that my comp, so what wound up happening here is, again, the comp sold for $525. We said the full bathrooms are $25,000. So if you just use common sense, you'd say, all right, well, if a full bathroom is $25,000 and they sold for $525, and I have 1 less bathroom, I'm probably worth $25,000 less. Simply put right here. So again, CBS, if the comp is better, you would subtract. So moving on to the next one here, to give you another example, the CIA. What if the comp is inferior? So let's say the situation worked out like this. The comp right here was 4 bedrooms and 1 bath. So the comp here is 4 bedrooms and 1 bath, and this sold for $475. And they say on the test, the comp is 4 bedrooms and 1 bath and sold for $475, and they have indicated that a full bathroom, the appraiser indicates that a full bathrooms are $25,000. What adjustment do you make here? Again, if it ever says make an adjustment to the subject, that's not your answer. You never, ever, ever make an adjustment to the subject. That's a rule, right? The only adjustments you make to the comps. So if all else is equal, my subject is 4 bedrooms, 2 baths. The comp is 4 bedrooms, 1 bath. What adjustment do we make here? Well, we know we make an adjustment to the comp, and then we just ask ourselves, CBS or CIA? If the comp is better, we subtract. If the comp is inferior, we add. Now, what's better using common sense? 4 bedrooms, 2 baths, our subject, or 4 bedrooms, 1 bath? Well, our subject property happens to be better here in this case. In other words, the comp is inferior. So if the comp is inferior, we add. And what would we add? The value of that bathroom, which we're assuming is, let's say, $25,000. And they'll tell you, what it's worth on the test. So what we would do here we add $25,000, and we come up with $500,000. So based off the adjustment that we made to the comp, we come up with a valuation of $500,000 for our subject. Again, we never, ever, ever touch the subject. The only thing we make an adjustment to is just the comps. Again, remember CBS and CIA. So hopefully this makes sense. Again, this is why I take these videos, so you guys can rewind if you want to go over it again. But we're going to move right along here. We're going to go to page 446. Now, on 446 here, it talks about GRMs, which is a gross rent multiplier. So I think it's the dumbest thing, for as far as evaluating properties, because if your gross rent is $10,000 and your expenses are, let's say, $30,000. I guess it's how you interpret it too, depending on how you interpret gross rent. But in general, what you're doing here, this is on the top left of 446. You're taking the sales price divided by the gross rent. And make these numbers really simple for you guys real quick. The sales price was $100,000 and your gross rent was $10,000. Your GRM is 10. You do the sales price divided by the gross rent. If they do ask that on the test, that's how you would do it. So again, sales price divided by the gross rent. You got an example on the top left of 446 here. But the next thing that we're going to go over here is the income approach. So the income approach, you would use this for income-producing properties, in other words, investment properties. So, and the whole purpose of the income approach is to convert income into value. So what you want to know is if this property is throwing off $100,000 in market value per year, how do I place a valuation on that? That's what we're going to talk about now. So the first thing that you guys should just write down, though, you should write down, if they ask you what is the purpose of the income approach, the whole purpose of it is to try to convert income into value. So write that down, then I'm going to go over the example here. So for the income approach, first and foremost, write down, the purpose of it is to convert income into value. One of the most common formulas they'll ask on the test is cap rate, capitalization rate. So to figure out your cap rate, it's your NOI, which stands for your net operating income, divided by your sales price. So again, your cap rate is your net operating income divided by your sales price. So to make this simple on you, make the numbers really simple. If they're asking you to calculate cap rate, they're going to have to give you the other two. They're going to say, all right, your net operating income was $10,000, and the sales price was $100,000. What's your cap rate here? Well, your cap rate is 10%. Because all I got to do is take 10,000 divided by 100,000. That'll give me 10%. They could ask these questions in reverse. They could say that they could say something like this. They could say you have a net operating income of $10,000. They could say you have a net operating income of $10,000. Your cap rate is 10%. What is this thing worth? And in that case, you work backwards. You figure out, you slap the 10% cap rate on that, and you do the multiplication on that, and you say, okay, that's worth or the division on that, and you would say, okay, that's worth $100,000 in that case. So, but in general, if you remember this formula, you could work backwards either which way. So formula is cap rate equals net operating income divided by sales price. One more thing I want you guys to note if they ask it on the test, cap rate and value, they're inversely correlated. So as cap rate goes up, value goes down. So going back to my original example here, if we have a net operating income of $10,000 and this thing gets sold for $100,000, we have a cap rate of 10% in this case. Now, to give you guys an example, let's say that I'm an investor and I'm greedy. I want to get this thing for a 20% cap rate. Now, in order to get this thing for a 20% cap rate, if my net operating income stays the same at $10,000, what do I have to get this for? Well, I got to get this thing, in this case, for $50,000. Why would I have to do that? Because at $50,000, my cap rate is 20%. So, as you see, in this case, the cap rate went up, and what happened to the value? The value went down, it sunk down. So, but, one more thing to just, really, drill this home to you. Let's say I'm a greedy seller, and I want to sell this thing at a super low cap rate. I want to sell it at a 5% cap rate. We're going to assume net operating income stays the same. So if I want to sell this at a 5% cap rate, and my net operating income is $10,000, what is 10,000 5% of? The answer is 200,000. So if I wanted to sell this thing for, let's say, a 5% cap rate, my net operating income is $10,000. I'd have to sell for 200,000. So again, if they were to ask you questions on that, again, cap rate and value are inversely correlated. As a cap rate goes up, the value goes down. So, definitely keep that in mind, I would say. One more thing just to note up here, while I'm on it. So if they ask you how do you figure out your net operating income, you take your gross rent minus your operating expenses. So give you guys just to make it really simple on you, if the rent checks that I receive are $10,000 and my operating expenses, the expenses that I'm paying out of my pocket are $6,000, I stick $4,000 in my pocket, that's my net operating income. That's my profit, basically. So your net operating income, if you want to write this down, it's your gross rent minus your operating expenses. So I would write that down. All right. And it also talks here about your economic life of the property. This is a term they could ask about as well. So your economic life, that is the useful life of the property. In other words, what that means, it's a period of time in which you can expect a positive return on your investment. So, one of the things they could say is, when does the economic life come to an end? Well, a couple things. Number one, when the value of land plus building equals just land, the economic life has come to an end. Now, that might just mean the property's been fully depreciated, and you actually could, wind up still making money, obviously, but it's been fully depreciated at that point in time. But these are all just different things we'll talk about. So, economic life, another word for that is useful life. So, economic life, that's the useful life of the property. What that means, period of time in which you can expect a positive return on your investment. A question I've seen before, they might say if the value of land plus building equals just the value of land, which of the following has occurred? And what's occurred is that the economic life has come to an end. All right, and then next here on page 447 on the right side, we talk here about the cost approach. Now, the cost approach, where might this be used? Maybe for a fire insurance policy. I want to know if this thing burns down, what is it going to cost me to rebuild? That might be one example. Also for the cost approach, they could perhaps ask a question like, they might say something like, where else might it be used? So just in general, we don't have a lot of comps or something. So maybe churches, schools, libraries, public buildings, brand new homes, fire insurance policies, things like that. Because if I, build a church, build a library, and somebody goes to sell it, are churches and libraries selling every single day? Schools selling every single day? The answer is no. So we have to find a different way to, evaluate this. We can't use a sales comparison approach because there's probably nothing to compare it to. So just in general, the cost approach, if they ask you where is it used, again, when you don't have a lot of comps for something, as a general rule of thumb, churches, schools, libraries, public buildings, brand new homes, or fire insurance policies, things like that. So that's really, in essence, kind of, the cost approach. And, underneath the cost approach here on the bottom right, talks about this, concept of depreciation. They might ask us, what can we depreciate for tax purposes? These aren't things we do in real life, but for the test they could ask. For depreciation, what you can depreciate for tax purposes, just the building value of income-producing properties. There's all different ways you can depreciate: straight line basis, accelerated depreciation, cost segregation studies, things like that. So we don't have to know all the details on that for our test. That's something you can look into further if you'd like to get your own knowledge on that. But just in general, what I'll write up here on the board for this, depreciation, they might ask you, what can you depreciate? The answer is just the building value of income-producing properties. Let me get this up here now. And if this is a residential building, you can do so over 27 and a half years, commercial over 39. And that's on a straight line basis. So residential. So if they ask you how long can you depreciate these things for on a straight line basis, residential 27 and a half years here, commercial 39. All right, so if you guys need to pause this and write this down, feel free. I'm going to turn the page here. So go to page 449, and here it talks about functional obsolescence, external obsolescence, things like that. So functional obsolescence is the loss in value due to the general outdated nature of a home. Give you guys an example of functional obsolescence. That's normal, that would not include, I should say, normal wear and tear, which would include things like chip paint, cracked patio, missing shingles. That's not functional obsolescence. Functional obsolescence is the loss in value due to the outdated nature of your home. So that would include things like poor floor plan, bad layout, 8 bedrooms, only 1 bathroom, small closets, no closets, choppy layout, things like that. Those type of things are functional obsolescence. And kind of the broad definition for this, they might say, which of the following best describes the loss in value due to the general outdated nature of your home? That's functional obsolescence. If you guys want to write that down, functional obsolescence, loss in value due to the general outdated nature of your home. And the other thing you guys should write down, this does not include things like normal wear and tear. So it does not include things like normal wear and tear. So again, functional obsolescence, the loss in value due to the general outdated nature of your home. What would this not include? It does not include things like normal wear and tear. And then as you see here, and again, feel free to pause the video and write that down. Feel free to also look in your book here on the left side of 449 for external obsolescence. So external obsolescence, that's a loss in value due to anything outside of your control, anything outside of your property boundaries. So what would external obsolescence include? Well, that would include things like you live next to an airport, you live next to a bus terminal, you live next to a train station, you live on the highway, so you live next to a factory and there's smoke and dust covering your house during the day. So these are examples of things outside of your property that could adversely affect your value. So if they say, which of the following best describes anything outside of your property boundaries that could adversely affect your value, we call that external obsolescence. You can't control those things. So again, external obsolescence, anything outside of property boundaries that could adversely affect your value. And then it talks about this term here below that on 449 about accrued depreciation. Now, accrued depreciation is the total depreciation built up over time from all causes. Accrued means to add up. So accrued depreciation, total depreciation built up over time from all causes. So, what would be some things that we would include in accrued depreciation? Just you're adding it all up over time. So for instance, if I was just doing it on a straight line basis, let's say $10,000 a year over 5 years, we've accrued $50,000 in depreciation. So if my basis for tax purposes was $500,000, it's now lowered to $450,000. So that's said to be recaptured when the property is sold. That's, kind of the concept of depreciation. So, what you have in there is, wearing and tearing, so you can depreciate that for tax purposes. Another way they could ask about accrued depreciation, they could say the value of everything brand new, if everything was brand new, versus the current valuation is equal to accrued depreciation. So again, the value of everything brand new versus the current valuation, what has happened over time. What's happened over time is what we call accrued depreciation. And then we get into the bottom left here. It talks about some ways that you can estimate what things might cost: quantity survey method, unit cost in place method, square foot method. Those are things that I don't necessarily think are the most relevant for the test. They could ask about them certainly. So just make a quick mention of them. Quantity survey method. What does that mean? That would mean like if I were to estimate what it's going to cost to build a home and I account for every nut, bolt, and screw. Unit cost in place method, much more common. We're accounting for every phase of the project. So how much does our excavation cost? Foundation, framing, siding, roof, electric, heat, plumbing, cooling. So it's basically accounting for every single part of the transaction. And then we have the square foot or cubic foot method. So we might say this house is going to cost us $200 per square foot to build. Well, if we say it's going to cost us $200 per square foot, and we want to build a 3,000 square foot home, all right, that's going to cost us about, let's say $600 grand, for example. So, that's just a quick, simple, lazy calculation. Obviously, those numbers differ depending on what you wind up doing. And then on page 450 here, it gets into talking about appraiser's licensing requirements. The number one thing I say to know about that for our test, for the appraised licensing requirements, is that if you're going to do an appraisal, you must be an appraiser. So, in other words, only a licensed real estate appraiser can do an appraisal. We as realtors, we do CMAs, brokers can do what's called a BPO, a broker's price opinion, but we as realtors don't do appraisals. So if they ask you who can complete an appraisal, it can only be done by a licensed real estate appraiser. Well, that does it for the book material for Chapter 22. As you guys know, you have the practice questions. In this chapter, I believe there's around like 50 practice questions. All the answers are in the back of the book. You guys have any questions on this, feel free to email me. If not, I'll see you guys in class pretty soon. So hope you guys enjoy this.